Advanced Financial Accounting OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to translation and journal entries. Get ready to account with Advanced Financial Accounting. Here we are in OneNote. If you're following along within OneNote, you don't have to follow along in OneNote, but if you have access to it and would like to, we are in the 1226, the translation and journal entries. We're under the problem presentations tab. We're going to go over all of the information first, then we'll work through the problem, taking components of that information as we do so. Translation and journal entries. On January 1st, 2000 X0, P purchased all outstanding stock of S located in Canada. So we got P is going to be the parent, S is going to be the subsidiary, S is a Canadian company, P is going to be a company that is in the US and therefore conducts their books in dollars as the measuring tool. The subsidiary conducting their books in the Canadian dollar. The purchase of the subsidiary was for $140,000. Dollars will be represented with simply a dollar sign. Canadian units will then be represented, Canadian dollars, with the CAD generally in terms of the numbering, so we can kind of differentiate. That's going to be one of the major components we, of course, will be dealing with here. So on 11X0, direct exchange rate for the Canadian dollar is going to be $1 to 0.81 US dollars. So 1 Canadian dollar to 0.81 or 81 cents on the US side. And then on 11X0, the S book value was in Canadian dollars, $94,000. Fair value of the subsidiary plant and equipment was higher than book value by 10,500 Canadian dollars. Depreciable life is going to be 10 years, so we're going to have to depreciate that increase in value. We're going to depreciate it over the 10-year time period. The remainder of the differential is attributable to trademark. So the remainder of the differential, we will calculate the differential, then we'll see the remainder, or we'll apply out some of that differential to this 10,500 for the property, plant, and equipment, the remainder then going to the trademark. In 2000 X0, the subsidiary earned $18,000, that being Canadian dollars, had dividends of 7,500 Canadian dollars, dividends paid when exchange rate was. So in other words, the exchange rate at the point in time that the dividends were paid was 1 Canadian dollar compared to $0.76. On 12/31/X0, the direct exchange rate was 1 Canadian dollar compared to 64 cents on the average, and then the average exchange rate is going to be 1 Canadian dollars to 0.75 cents. It is determined that the Canadian dollar is the subsidiary functional currency. So the functional currency of the subsidiary that has been purchased, we've determined the functional currency to be the Canadian dollar, the foreign currency. So make schedule to show the differential allocation and amortization for the 2000 X0. Okay, so now we're going to take that information, we're going to fill out some of our tables here, and the first thing we'll be calculating will be that differential on the sales side of things. We're going to pull the pieces of information from up top that are relevant to the calculations we are now making. So we're going to start off with the investment cost. So the investment, in other words, that P purchased the subsidiary for, that was in dollars, given to us in dollars. So we're going to start off basically on this side. So we're thinking about filling out the US dollars first, which would be the 140,000. We're then going to use the exchange rate, which is going to be the 0.81, which was the exchange rate on 1/1, the point in time that this took place. And then we'll kind of back into using that exchange rate. That exchange rate is usually the exchange rate you have when you go from Canadian dollars to US dollars, but we're just going to divide to go the other way, right? So we're going to take the 140,000 divided by the 0.81, and that's going to give us the 172,839 about, or 840 about. There will be rounding involved here, so bear with us and note that the rounding will throw things off just a tad. So then we have the book value of the investment on 11X0, which is given to us here. It's given to us in Canadian dollars this time. So now we're going to be looking at the Canadian dollar side of things, multiplying that times the exchange rate. So we're going to take that 94,000. We'll take that 94,000, multiplying times that same 0.81 exchange rate to get to the 76,140 in the US dollars. That means that the differential that we have in Canadian dollars, differential in Canadian dollars, 172,840 minus the 94,000, or the 78,840. The differential in US dollars, 140,000 minus the 76,140. 0.140 is going to give us the 63,860. We're now going to apply that differential as it was given in the problem to the property, plant, and equipment, which it was given to us that was 10,500 above the property, plant, and equipment being above the book value by 10,500 Canadian dollars. So we're going to put the 10,500 Canadian dollars here, once again converting that 10,500 times the 0.81, that being the 8,505. So we have the 8,505. Then the difference between the differential and that 8,505 is going to be going to the trademark. If we think about that in terms of Canadian dollars, 78,840 minus the 10,500, and that's going to be the 68,340. If we think about that in terms of US dollars, we got the 63,860 minus the 8,505, and that's going to be the 55,355. So now we're going to be looking into this differential. We have this differential we've now applied out to these two areas. The differential applied out to the book and the trademark, so an intangible asset and the book value, the property, plant, and equipment, both of those having an income component being the depreciation involved with them and the amortization that will be involved. So now we're going to consider this differential. We're going to consider it for the plant and equipment. Remember, this is the same differential we calculated up here. So this differential are going to be these two items, the 8,505 and the 55,355 for the property, plant, and equipment and trademark respectively. So we got the plant and equipment and the trademark. This is in Canadian dollars. And then we've got the plant and the equipment and the trademark in the US dollars. So we've calculated both those up top already. We're just putting them in a different format. So on the Canadian dollar side, the 10,500, the 68,340, 10,500, 68,340, and on the US side, the 8,505 and the 555,355. If we had either one of those, of course, we can use the exchange rate as well to get the other. We could say, all right, 10,500 times the exchange rate 0.81 is going to give us the 8,505, and we can take the 68,340 times the 0.81, and that's going to give the 55,355 about. So we got some rounding issues still involved. Then we're going to take a look at the depreciation and amortization. Now, when we look at the depreciation and amortization, this is going to be the kind of the trick here, or the tricky part, the kind of confusing component, because we want to take that on the Canadian side of things and then use the relevant exchange rate to take them over to the US dollars. So you might think that we can just take the US dollars and divide it by the same useful life, and we may be able to do that if we were using the same exchange rate. But now, since we're talking about an income statement amount, we're going to be using the average exchange rate. So if you think about this, you got to say, all right, well, now we got depreciation, and the depreciation is on the subsidiaries books, and the subsidiaries books are really in the Canadian currency. So we should really be calculating the Canadian currency depreciation and amortization, and then transferring them over, not using the 0.81, but rather using the rate that we use for the exchange rate on the income statement, which is going to be the 0.76, the average rate over the time period, rather than the rate at the end of the time period. So then we're going to say, all right, let's do this then. We're going to say then that 10-year life on the depreciable asset, so 10,500 Canadian dollars divided by 10 is going to be 1,050 Canadian dollars. Then if we use the exchange rate, now we're using the exchange rate, which is the average rate. I don't have it down here, but it's the average rate. Trust me, it's the average rate, instead of the rate at the end of the time period, which is that, or the beginning or end of the time period. This is the rate at the beginning of the time period that we had here. This was given to us up top as of 11x0. So of the rates we can think about, you'd say, okay, well, this is the depreciation for the time period. What rate are we going to use here? We're going to use the average rate, because this is something that's going to happen on the income statement. What's happening on the balance sheet? Oftentimes the balance sheet, when it's the ending numbers, we're using the ending date as of the end of the time period. And when we're talking about the beginning numbers, as we were when we first calculated the differential, we're using the beginning numbers when the purchase took place, which is this 0.81. So once again, if we took that 1050 times the 0.76, we're going to get that 798. Now you might say, if we just for comparison's sake, if I took the 8505 divided by 10 years, we don't get the same number. So we can't do it because we used a different rate here. So it doesn't work that way. Right? So that's going to be the kind of tricky thing. So then we have on the trademark, same thing. We have the 6834, and I think we just said 10 years on that one too. So divided by 10, and that's going to give, I'm sorry, let me do that one more time. This is the 68340 divided by 10. That's going to give us the 6834. Multiplying that times the average exchange rate, 0.76, is going to give us that 5194 about, which is different than what we would have done if we took the US dollars, 55,355, divided by the same 10 years, different number because of that different or changed rate. So then we have the remaining balance. So the remaining balance, we're going to be just simply subtracting this out. So the 10.5 minus the 1050 is going to be that 9450. Same here, subtraction, subtraction, subtraction. So I won't do all the calculations there. Then we're looking at the balance sheet side of things. So we got the remaining balance translated at year end. That's going to be we're just pulling these numbers down, the 9,450. So this is what is remaining, right? Because this was the added amount that was increased to the property, plants, and equipment and the trademark on the balance sheet. This is what it was reduced by on the balance sheet, accumulated depreciation and reduction of the trademark, and recorded basically on the income statement as depreciation amortization on the balance sheet. Then we're left with this amount, the remaining balance on the balance sheet for that added property, plants, and equipment, and the amortizable asset, the intangible asset. So then we're going to take that amount and multiply it times the exchange rate. Now, when we're taking these amounts, we're talking about the amount at the end of the time period. At the end of the time period. So we're going to now use a different rate again, because when we look at the end of the time period, I'm going to scroll up a bit to get there. We're using the end of the time period, which is going to be 1231. So at 1231 x0, the exchange rate is 0.64. So the main point here is that we're using a different exchange rate again, because now we're talking about balance sheet accounts at the end of the time period, and most of the balance sheet accounts, asset and liabilities, these being assets, we're going to use the end date, because on the balance sheet, when we convert the balance sheet to the US dollars, it makes sense to use the end date most of the time, because the balance sheet is as of a point in time, that point in time being the end of the frame. So if you say the financial statements for the year ended December 31st, then the balance sheet is as of December 31st, and therefore it makes sense to use the balance sheet exchange rate number. So that's what we'll use here. We're going to take the 9450 times the 0.64. That's going to give us the 6,048. If we do the same thing for the amortization, the trademark, 61506 is remaining times the 0.64. So that's going to give us the 39,364. So now we converted, we got these balance sheet numbers that we did by using the balance sheet end date versus basically the same what we would have got on the balance sheet numbers had we used these exchange rates, which we used the beginning exchange rate here and then the income statement exchange rates to get to what would have been the same numbers if we used the same rates, but now they're different. And that's going to cause us a problem. That's going to cause us a differential. So that's going to be the translation adjustment to other comprehensive income. We're going to record that too, which of course will be the difference between these two, 7707 minus the 6048. So now we've got this adjustment we're going to have to make because we use these different exchange rates as we went through, because we're not going to be in balance anymore. 50,616 minus the 39,364 is going to be our differential there. If we add those two up, total differential is going to be that 12,456. 12,456. So now that we have that, we're going to think about the fully adjusted equity method journal entries that the parent would be recording related to the subsidiary. As the parent records these journal entries, note that they're going to be recording them in, of course, the unit of measure that they used, US dollars. So we'll have to think about any kind of adjustments that need to be made to do so. First, we'll just record the initial investment, which is just the same as any kind of equity method that we have seen in the past, because the original investment was in dollars. So no exchange rate needs to take place. That would be increasing the balance sheet account, the investment of the $140,000. If cash was then paid, the credit would then be going to cash for the $140,000 on the parent's books, using the equity method fully adjusted to account for the investment in the subsidiary. Next, we're going to record the income now. So now we're going to record the income that was earned by the subsidiary, but of course it was put on the books in Canadian dollars. So we're going to say the subsidiary's net income was $18,000 in Canadian dollars, which we're going to have to convert now using the exchange rate. What exchange rate should we use will be the question then. We're going to use the average exchange rate. The average exchange rate, because we're talking about the income statement now, net income, and that the typical rate you would think would be, well, we couldn't just choose one date. Doesn't make sense, because the income statement is covering a time frame. It has a beginning and an end. So we should try to pick some rate that's representative of the entire range, which is going to be some kind of average rate. So we're going to pick up the average rate then. So we're going to take that 0.76. So we're going to take that 18,000 net income in Canadian dollars times the exchange rate, which is the average exchange rate, 0.76. That's going to give us our 13,680, which we can now record as the investment, increasing the asset and increasing the income side of things. Next, we're going to have the dividends. So the dividends went out from the foreign company, which we own 100%. And when I say we, I think of ourselves as the parent. We're the parent company here. So we own like the subsidiary. So they gave out dividends, and we own 100%. So all the dividends went to us as the parent. But the dividends went out in Canadian dollars because they came from the subsidiary, which is in Canada. So then we got 7,600 Canadian dollars. And we actually got the Canadian dollars. So we're not going to put cash on our books because we got money, but it's not our currency. It's the Canadian currency. So we put it on our books as foreign currency units, representing the units that we got, 7,600 units of Canadian dollars, but we're going to have to measure them in US dollars just like we would for any other kind of asset that we would have. So we're going to have to use the exchange rate. What exchange rate do we use? We're going to use the exchange rate this time for the time period when we actually got the Canadian dollars to value them in US dollars so we can put them on our books in that time frame. So we're going to say then we got the 7,600 dividends times the 0.75, which is the exchange rate at the point in time we got the dividends, increase in the foreign currency units, which is an asset, kind of like a liquid asset. It's like cash. We could spend that money and whatnot, but it's not cash, right? So it's representing 7,600 units, and then we're going to credit the investment. Now, of course, now that we have that units on the books, we'll have to account for them just like we would if we bought stocks or bonds or something like that. We might have to then adjust them for the market value changes that take place over time. So then we're going to say that the next item will be the adjustments that we had related to the differentials. The adjustments related to the differentials. Now, you could kind of combine these together, or you can break them out separately. But you will recall that we had the adjustments. Where did we put those adjustments? Let's go up here and find them. We had this one here for the depreciation amortization, which we calculated the depreciation and the amortization, and then we converted it to dollars. So we're picking up that 798. So the 798 then is going to be a decrease in the income from S and a decrease to the investment in S. Same thing for the amortization. The amortization of the 5,194 amortization, same thing. It's going to be decreasing the income from S, decreasing the investment in S. Then we're going to have the other comprehensive. This is going to be our translation adjustment that we're going to have to put in place. And you'll see that we recorded that. Remember up here, we said that we had this difference because of this change that we made up here. And so we're going to have this differential to the other comprehensive income. It's going to be a translation adjustment because we use these different rates to translate the thing instead of just one rate, which would have been like so much easier. So we're just going to take this 1,659 plus the 10,798, which is our difference of that 12,457, and we'll debit the other comprehensive income translation adjustment for the 12,457 and credit the investment in S. Okay, so the next thing we're going to do is we're going to take a look at the proof of translation adjustment. We're going to get to another basically translation adjustment here. We're going to have the Canadian dollars, the exchange rate, and then the US dollars as the format as we go through this. Let's put our little hiding reveal thing. So we're going to start off with the net assets at the beginning of the year, the 94,000. This was in the Canadian dollars, so the 94,000 Canadian dollars. We're using the exchange rate. The exchange rate here being used is the exchange rate at that point in time at 11x0, the point in time that the purchase took place. Multiplying that out, we've seen this in the past, the 94,000 times the 0.81 is going to be the 76,140. Might be a difference due to rounding, but about. So then the adjustment for the changes in asset position. So now we're going to have the adjustments for the changes in the net and the asset position. This is the beginning balance. The major change being the net income for the year. So the net income for the year for the Canadian company was that 18,000. Once again, we got that from up here. We've seen that in the past. We're going to use the conversion rate. Which rate are we going to use to convert the net income? We're going to use the average rate because the income represents, what happened over a time frame, a beginning to the end. Therefore, we're going to use some type of percent representing that entire time frame, that being the average of 0.76 to get to the 13,680. Then we've got the dividends paid. So the dividends paid were the 7,600 of the dividends that were paid. Once again, those being in the foreign currency. We're going to have to exchange those as well. The exchange rate used there is going to be the exchange rate at the point in time the dividends were given in, that being the 0.76 to get to the US dollars of the 5,700. The 5,700. So then the net asset translation at rates in effect for those items, we're going to say that are going to be here. So then we're going to add these up. So the 76, we're looking at just the cash side of things, right? So we're looking at the cash side of things because now we're looking at it as we use these different rates to figure out these different components from going from the beginning point in time of the net assets, kind of like the full equity section at the beginning, and then having the adjustments, the net income and the dividends to get to the ending balance. So this plus this minus the 5,700 gives us the 84,120. Then we're going to take a look at the net assets at year end in Canadian dollars. So notice we're all using the same units here, not changing the exchange rate because these are all in Canadian dollars. So then we're going to take the 94 plus the 18 minus the 7,006, giving us the 104,400. Then exchange the ending balance of the net assets in Canadian dollars using the rate that we would use on the balance sheet typically, that being the year-end rate. That year-end rate at 12/31 being 0.64. So if we multiply times 0.64, we come out to a different number than having taken the components and multiplying them by three different rates that we've seen up top, that number being the 66,816. So then we have a change in the other comprehensive income. This will then be the adjustment, which is going to be the 84,120 minus the 66,816. That's going to be our change in other comprehensive income, the translation adjustment. And then if we record that out, we're going to have the other comprehensive income is going to be the 17,304, and the investment in S then being the credit at the 17,304 related to that difference.